President has also been pushing for lower interest rates, saying they should go hand in hand with tariffs. But our next guest says it's not the time to cut. The Fed should keep rates on hold, she says. We've got good growth, healthy labor markets, sticky inflation. Loretta Mester is here with us. She's the former Cleveland Fed president, currently adjunct professor of finance at Wharton School of Business and a CNBC contributor. It's great to see you. Welcome.
Thank you very much for having me.
So the big development this week, CPI, is that why we're on hold? And it was interesting to have the president say lower rates should go hand in hand with tariffs, when, if anything, tariffs probably make lower rates less likely, or maybe they don't.
Yeah. I mean, the CPI was just another confirmation that the progress on inflation coming down has stalled since the fall of last year. And so, given that the economy still is healthy in terms of the labor market and growth, we saw that the economy grew at 2.5% last year. That's really good. It was 3% the year before. That's very healthy growth. It's above trend, right? There's no reason for the Fed to be moving rates down at this point. They need to hold and wait and see how things develop. And so that, it was another confirmation that we haven't seen the progress that we'd like to see on inflation. It doesn't mean that inflation won't start to move down later this year. No, you can't say that yet. We saw higher inflation numbers at the beginning of last year as well, and then inflation began moving back down. But I would say at this point, there's no compelling reason to cut rates, and holding this seems to be the best play here.
Should they have cut rates? I mean, they did cut rates by 1% last year.
Yeah, I mean, the rates were very high and very restrictive at that point, and we had seen a lot of progress on inflation, so they were bringing them down. Now, it's debatable how restrictive the current interest rates are, but I would say most economists say they're still somewhat restrictive, and we'll have to just hold here for a while to see what's coming. Well, there's a lot of uncertainty, as we've talked about, coming out of the...
Well, the bond, as you know, Laura, the bond market, listen, the Fed's done what they've done.
Right.
So what do you always say? You get what you get. You don't get upset. Don't get upset. Well, the bond market got upset.
Yeah. Well, the bond market is reacting to a lot of things, right? The bond market yields went up partly because they were more euphoric about what was the outcome for growth coming, right? So there was a real play. There was a term premium in there worrying about the deficit, right? And then there was what the Fed was doing. So I don't think you can point to the Fed as being driving that 10-year
The weird thing,
Treasury market.
I don't know if we have this chart ready, but it would be a chart of monthly job growth over the past 12 months. And this eerie thing happened where job growth started to slow throughout the summer. We had that yen carry trade things, setting markets lower in August. And it looked like the economy's rolling over, the markets are rolling over, and that's why they cut 50. Okay, fine. Then immediately jobs started to pick up again. And so those facts changed. And I'm trying to figure out, if you're the Fed, what do you do about that? I mean, this is such an unusual cycle.
Yeah. Well, you do know that when the data comes in, that they can be revised. And so that's why the Fed always says, look, we don't move on one data point. We're going to look at what the data is telling us. And you're exactly right. I think the reason they started cutting in September was because, right, they hadn't made all that progress on inflation. The size of the cut, whether 25 versus 50, I think was driven by their concerns about some of that, what was going in the labor market and some of those reports. Now, you're right, that got revised away.
Well,
but the labor market,
but then it picked up again.
Yeah, but it is a moderation from what we saw, earlier last year in terms of the growth rate in employment. So I would say that it's still a healthy labor market. It's still, in balance, supply and demand, which is what you want. You don't want overly tight labor markets or, overly loose labor markets. So it's an imbalance. But that's something that they're going to be looking at going forward, partly because of the uncertainty around what some of the forthcoming policies will be. They're going to have to be very attuned to that.
You're an Ohioan. Where are you from originally?
Baltimore.
Baltimore?
Baltimore, Maryland.
You got to say without the T. Baltimore.
Exactly.
Charm City.
Yeah, exactly.
Right?
Yeah.